Good evening and welcome back to my channel. And before you continue watching this channel, please subscribe to my YouTube channel. Let us get to 1,000 subscribers in the next 30 days. I'll also like to inform you that our intake is ongoing for September. So join us by contacting me through the number on my bio on this channel, so that I can prepare you for the December sitting, which is coming the next 3 months. So thank you so much, and without much ado, let me continue the revision for the 2024 August sitting. And today I'll do question 24. And this was a question on audit schedule. When you check our mock, you are also able to predict correctly that they will test your knowledge on audit schedule. So I'll read the question. So it was question 24. You can see my screen now. So I'll read the question. In this section 3, and it was 20 marks. And this section, you choose between audit and a question on taxation. But this time around, they tested your knowledge on pivot table. And we'll be able to do that question. Yeah, and I'll share that video for question 25. So they tested, there was no taxation this time around. They tested your knowledge on whether you know how to prepare pivot table. Actually, they tested your knowledge on whether you know how to do presentation, the visual presentations. Yeah, so let me go back to the question that we have to tackle. So this is question 24. So I'll read the question. As an audit senior at a roofing audit firm, you have been made responsible for planning the audit of Lead Team Manufacturing Limited for their ending 31st December 2023. Below is a summary of key information about Lead Team Manufacturing Limited. So you have revenue, net income, total assets, inventory, and accounts receivable. Yeah, then the accountant and Lead Team has further provided you with the following list of accounts balances at the 31st December 2023. So we have the accounts here, then additional information, number 1. As of 31st December 2023, accounts receivable balance included shillings 250,000 due from a customer who had been declared bankrupt, while accounts payable was found to have been overstated by shillings 150,000. We'll come to adjust that. Number 2, the allowance for doubtful debts is to be adjusted to 3% of the accounts receivable as of 31st December 2023. Number 3, as of 31st December 2023, there were prepayments of shillings 50,000 and shillings 75,000 towards administrative and advertisement expenses, respectively. For the same period, there was an accrued amount of shillings 120,000 towards audit fees. Number 4, the company paid the due interest on the long-term debt on 7th January 2024. Number 5, depreciation is provided as follows: buildings at 5% per annum on cost, heavy machinery 10% per annum on reducing balance. Number 6, the company annual general meeting resolved that preference dividend be paid, a dividend of 11% on ordinary shares be paid, then shillings 3 million be transferred to general reserves. The number 7, the company maintains a gross profit margin of 25%. Yeah, we'll come to that. Then 8, having been made aware of significant changes in the ERP system, the CFO position and business routes, you are concerned about the materiality assessment of the audit. Required, determine the planning materiality for the audit based on the revenue, net income, and total assets. Yeah, so it was based on the revenue, net income, and total assets. Then justify your choice of the basis and the percentage used. That was 6 marks. So they were testing your knowledge on materiality. Yeah, part B, prepare the original adjustments and adjust the trial balance with the debit and credit columns each. That's 6 columns. So we'll have the original trial balance, then we'll have the adjustments, then we'll have the adjusted trial balance after the adjustment. So this trial balance will originate from this information here, the information which was provided by the accountant, because that's what you rely on when you are preparing the audit schedule. Yeah, so I'll start with the part A, determine the planning materiality for the audit based on the revenue, net income, and total assets. Justify your choice on the basis and the percentage used. So here, it was upon you now to know what materiality is. So materiality in audit, yeah, you should have done audit to know what materiality is. So materiality are those misstatements that may influence the economic decisions of stakeholders. Yeah, like when you misstate a statement, maybe you misstate a statement, it will have an effect on the stakeholders. Stakeholders are the shareholders of the company. Yeah. So on this question, they were telling you to determine the planning materiality. So there are two types of materiality. We have the planning and the performance materiality. So at the planning stage, this is how you do materiality at the planning stage. Yeah. So the planning stage, the first step when you're determining material at the planning stage, at planning materiality, is that you check at the benchmark. The benchmark is the basis. Yeah, the base. The base, what do you choose? Yeah, and here we are given 3 items. We have revenue, we have given net income, and we have been given total assets. So this is how you argue when you want to determine the materiality at the planning stage. Yeah, yeah. So here at the planning stage, you only select one base. Yeah, you select only one base. So that's the basis. So here you won't calculate for revenue, net income, and total assets. No, you only choose one basis at the planning stage. Yeah, that's the standard. That's the ISA 320, the ISA 320 standard. Yeah, because here now you're using the standards of auditing. So at ISA 320 dictates that at the planning materiality, you select only one base for materiality. Yeah, so we'll only choose one base. And that base, you will be guided. Yeah, you look at the question, you look at the nature of the industry. So what was the nature of this industry? That's what you check first. So we are told that it was a manufacturing company. Yeah. So you have to know the nature first. So the nature of the industry was that it was a manufacturing company. So a manufacturing company, those are companies that are profit-oriented. Yeah, that's a profit-oriented company. Yeah, so a profit-oriented company will look at the 2 major items. Yeah, the stakeholders will be concerned as a manufacturing company. They will be concerned about revenue and the net income. Yeah, income in this case is the earning, is the pre-tax earning. Yeah, is the profit before tax. Yeah, that's the net income which you have been given here. So this net income is the earning before interest and tax. Yeah, they call it the pre-tax earnings. Yeah, so in a manufacturing industry, the stakeholders, who are the shareholders, will be so interested on revenue or net income. So in this question, now we'll know that we'll be concerned about revenue and net income because the nature of industry is manufacturing. So the shareholders will be so concerned about revenue generated and net income. So that will do away with the total assets. So we'll narrow down to the 2. So because we say that at the planning stage, you only calculate materiality for only one item. So we have narrowed down. Now we have net income and revenue. So how are we going to now choose between revenue and the net income, which is the profit before tax in this case? So this is what you do. When you check, when you always check, when you do the material, you use what you call the professional judgment. Yeah, that's your own judgment. Yeah, nobody is supposed to guide you. It's your professional judgment as an auditor to determine the base. Yeah, so here, I'll go with the profit. I'll go with the profit before tax, which is the net income. Reason being, when you check at the revenue always fluctuates. Yeah, the revenue is not standard. Revenue fluctuate. It can fluctuate depending on the business environment. Yeah. Then when it comes to profit before tax, first it's relevant. Yeah, because you can only be able to determine your income. You can only give an advice based on the profit before tax. Yeah, because that's predictable, that's stable, and that's also relevant. Yeah, but for the turnover, which is also known as revenue, it's relevant though, but not predictable because it's keep on fluctuating. Yeah, it's keep on fluctuating. So the base which I'll select under this, I'll select the net income. I'll select the net income. So the examiner was testing your knowledge. Yeah, so yeah, I will say, they said determine the planning material for the audit based on the revenue net income, justify your choice for the basis and the percentage used. Yeah, so I'll just come here and say base. Yeah, it's called base on the benchmark. Base stroke benchmark. Yeah, so by base, here, I'll pick the net income. Yeah, so the reason being, my first reason will be lead team. Yeah, this is now audit. Lead team is a manufacturing company. Manufacturing company. And manufacturing company is a profit-oriented company. It is a profit-oriented company. Yeah, that's why I'm picking on the net income. Yeah, because the stakeholders, the shareholders will be concerned much about the profit. Yeah, they will be concerned about the profit, not the net assets. So if it, or not the total assets, because the total assets now, if it was an investment company, then we'll be so much concerned. The basis will be the total assets. Yeah. So I've also disqualified revenue because revenue fluctuates. Yeah. Yeah. It's unpredictable. Yeah. And one of the key drivers of determining materiality at the planning stage, because we say that the standard is you use only one base. Yeah. You can't use net income and revenue at the same time. So we have eliminated revenue because it's fluctuate. But the characteristics of profit before tax, which is net income, is that it is stable, always predictable, and relevant. So you always choose the net income at the planning stage. Yeah. So the base is this, and we have chosen net income because it's a manufacturing company, which is a profit-oriented company. So you only select one base. That's our reason along that line. So after that, we are yet to calculate the materiality because we'll calculate it. So after that, what you do, you check. You check whether you do what we call the professional judgment. Yeah, so you as an auditor, what is your professional judgment? So my professional judgment can differ with the professional judgment of the other auditor. So because I've chosen net income, there are always guidance according to IS 330, the rates that you are using. Yeah. So for profit before tax, which is net income, in this case, it's always the lower materiality is always 5%, and the upper is 10%. So I'll write that. Yeah, you see how they're saying justify your choice of the basis and the percentage use. Yeah, so these are the percentage use. So I have to justify. Already I've justified why I've chosen net income. Now I'll justify why I'll choose 5% or 10% to calculate the materiality. So the next thing you check, after now you have then identified the guidance, the percentage, because for profit before tax, which is net income, it's 5% to 10%. For revenue, it was revenue, we'll use 0.5% to 1%. Then if it was total assets, we'll use 1% to 2%, which is the higher. So this is found in the ISA 320, yeah, in international standards on auditing. Yeah, they are there. So the rates, you are supposed to get them there. So 5% to 10%. So which one will I choose here to calculate the materiality? So this will depend with the risk involved. Yeah. So as an auditor, you have to know that the high risk, whether there's high risk happens where we have new client. Yeah. When you are auditing this person for the first time, then that's high risk. So the high risk will be associated with the new client or a listed client. Yeah, a listed company. If the company is listed, then it has so many shareholders. It's in public. Yeah, so the risk is higher. So the opposite is true, that if your client is not new and the company is not listed, then it means that the risk is low. Yeah, so let me just write it here for teaching purposes. So in this case now, we know that this was not a listed company. We just told that it was a manufacturing limited. We are also not told whether it was a new client. So the client was not new and the company was not listed. So it means that the risk is low. Yeah, so the risk is low. So you just say the risk, the risk is low. Yeah, so the risk being low in this case, and we know that there's an inverse relationship between risk and materiality. So it means that when the risk is higher, the materiality is low. While when the risk is low, then we use the materiality is higher. There's an inverse relationship between risk and materiality. I've told you that high risk is where we have a new client and we have a listed client. In this case, this team lead, it's called lead team manufacturing, is not a listed company and is also not a new client as per the information provided. So it means that the risk is low. So when the risk is low, then materiality is higher. So it means that because the risk is low, materiality will be higher. So instead of using 5%, we lose 10% when we are calculating materiality. Therefore, the materiality in this case in this case will be 10%, yeah, because we said the risk is low and it is inversely proportional to materiality. Yeah, it has an inverse relationship. So it means that when the risk is low, materiality is higher. When the risk is higher, materiality is low. So here, for us to determine the materiality, we lose which percentage? We lose 10% because it's low. Now materiality will be the higher one, which is 10%. So just say equals to 10%. Then you multiply by the amount which you're given under the net income. This amount here, 7250. Yeah, so the material will be 725,000 because the shillings were in thousands. Yeah, remember the shillings were in thousands. So I can just put it here. There's no big deal. So shillings were in thousands. So materiality is 725 because we use the 10% because the risk is low. So materiality is higher. Yeah, so we'll take 10% and the materiality is 725. So yeah, so this is what the examiner required from you. Determine the planning material for the audit based on the revenue. So in net income and total assets. So we have identified as net income and we have said that it is because it's a manufacturing oriented company, a profit-oriented company because it's a manufacturing company. Then we have said that under the professional judgment, we'll use the guidance of 5% to 10%, which is the net income. And the risk is low since it's not a listed company and the client is not new. That's why the materiality now we are using the 10%. So you come here and justify because they're saying justify your choice of the basis and the percentage used. So the basis I've justified here, I'll get a mark there. So for the choice of the percentage is that lead team is a lead team is a low risk client since it is not a new client and the company is not listed. The company is not listed. Just the justification. Yeah. Yeah, why I've used 10% but not 5%. Yeah. So if it was listed, if it was a high risk company, meaning it was listed or it was a new client, then I will have calculated the materiality by 5%. So I think I've explained that. And yeah, that was a very challenging question because as we teach this, we have been only teaching the preparation of of the audit stage where we prepare the trial balance and the adjustments. Yeah, so yeah, this now was testing your knowledge as an auditor, because this is a practical paper. This is a practice paper. So you have to know, yeah, you have to know the materiality. When you are doing audit, then this paper assumes that you have done the audit before. Yeah, so you know what planning materiality is and what happens at the planning materiality. Yeah, next time maybe they will ask you about performance materiality. So without much ado, let me continue to part B. So that's how you're supposed to answer that question. Determine the planning material for the audit based on the revenue, net income, and total assets. Justify your choice of the basis. The choice is net income, and we have justified. And the percentage used, I've identified why. I have justified why I've used the 10%. So I've used the 10% because lead team is a low risk client since it's not a new client and the company is not listed. As simple as that. Yeah, so we go to part B and you'll get 6 marks for that. Yeah, you'll get 6 marks for that. That's what you are supposed to do. Yeah. Part B, prepare the original adjustments and adjust the trial balance with the debit and credit columns each. Therefore, 6 columns. So this is what I will do. Yeah, this is now the audit schedule, the normal. Yeah, I think we won't have so much problem. So this is what I will do. So we'll rely on this information provided by the accountant to prepare the trial balance. Yeah, so they say that we start with the original. So we'll start with the original trial balance as per the information given. So just say original trial balance. Yeah, so we'll always have the debit and the credit side. Yeah, you debit as you credit. Then we'll have the adjustments. Yeah, as per the question, they've told us about adjustments. We'll debit. And credit. Then we'll have the adjusted now. After the adjustment, we'll now have the adjusted trial balance. Adjusted trial balance. Good. Sorry. Let me undo that because that place is for debit. So let me just say adjusted. Yeah, I can just leave it there adjusted. And you know that's adjusted trial balance. Yeah, so just copy that. Copy this once again. Then the shillings were in thousands, if I recall. Yeah. Let me increase that and drag that all the way. Yeah, so the shillings were in thousands. Let me increase that batch. Yeah, so let me bold this and also bold that. Well, yeah. So what I will do, let me just copy the information provided there. So I'll just copy because this is what we'll prepare the trial balance with. So I'll just copy this, then I paste. Yeah, it saves you on time. Control C. Come here and say, yeah, Control V. Yeah, so we have that. So let me increase the size of this column. Oh, well, very well. So we are preparing the original. So you know that for the debit side of the trial balance, you will pick expenses, you will pick assets, and you also pick drawings. Yeah, assets, expenses, and drawings. Then on the credit side, you will pick equity, liabilities, and income. Equity, liabilities, and income. So once you have that knowledge, yeah, you just move on and you'll be able to balance. Yeah, so we'll start with accounts payable. So that's a liability. So I'll credit it. That's a liability. So you credit it. Accounts receivable, an asset, we debit. Cash in hand, an asset, you debit. Inventory, an asset, you debit also. Return outwards, that's the purchases return. Yeah, so as you debit purchases, you credit the purchases return, which is the return outwards. Yeah, so you credit it. Yeah, that's purchases return, also known as return outwards. So you credit it. The return inwards, that's the sale return. So you credit sales as you debit the return inwards, which is the sales return. So you debit the sales return at 250. Yeah, that's a return inwards. Then ordinary share capital is an equity. So we credit it. Yeah, 10% preference share, that's also an equity. You credit 9% long-term loan liability. We credit. Sales is an income. Yeah, that's revenue. So we credit also sales. Then purchases, you debit. That's an expense. Yeah, you spend money to purchase. So purchases, you debit. Bank overdraft is a liability. You credit. Discount received. Yeah, this discount received. Yeah, so when you receive discount, that's income. Huh? Yeah, so you credit it. Discount received. Yeah, the discount allowed is you or who is allowed. So that's an expense on your side. Eh? So you debit because it's an expense because you are the person who is giving out the discount. Building at cost, that's an asset. So you building at cost, you debit. Machinery at cost, it's also an asset, you debit. Sorry. Let me pick that. Debit that. Then accumulated depreciation. That's a liability. So you will credit it. Accumulated depreciation for building. Then we also have for machinery. Yeah, you credit the accumulated depreciation. Audit fees is an expense, so I'll debit it. How much? 11 to 62. Administrative expenses, as the name suggests, it's an expense, so you debit. Advertisement expenses, you debit. Bad debts written off is an expense. You debit. Allowance for doubtful debts carried forward. This is what has been brought down. So it was carried forward from the previous year. It has, so that's a liability. Yeah. So it's a liability. So we'll have to credit it. Yeah, it's a provision. Yeah, so we debit it. So where is it? 300. The retained earnings. Yeah, that's an equity. You credit. Yeah, so that's how you're supposed to do part one, the original trial balance. Yeah, so what I will do, because I've been doing adjustment, I told you that you have to leave spaces, and these spaces will depend with additional information provided. So let me see, we have 8 additional information. So let me allow like 10 spaces. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Yeah, just for any adjustment. Yeah, so let me land there after the 10th. That's what you do. Yeah, to save on time. Yeah, to save on time. So you create the spaces for adjustment. So I'll sum here and we see if it balances, because it's supposed to balance because there was no suspense account. Yeah. So we sum it. So I'll sum all this. Sorry. We're up to there. So it will give me 196,472. Let me see if I drag, it will balance. Yeah, it balances at 196,472. Yeah, so it's balancing. So allow me just to all the way. Let me just, so that when we get the answer, it will just copy. So let me, so that was adjustment. Yeah, up to there. Yeah, so let me, so that when we adjust, it will just copy automatically. The totals will come out automatically. So that's how you are supposed to do part one of that question. That's the original trial balance. Yeah, so we'll go to adjustments, and adjustment will be guided by the additional information. I told you that. Yeah, don't prepare original with additional information. This is for adjustment. So I'll do for first. Number one, as of 31st December 2023, accounts receivable balance included shillings 250,000 due from a customer who has been declared bankrupt. So let me start there. So that was 250, but recorded on accounts receivable, but was due from a customer who has been declared bankrupt. So that's bad debt written off. So yeah, there's a customer. So we continue with the adjustments. So I'll start with the one. So we are told that there was 250,000 on the accounts receivable. Yeah, so that will debit the bad debt written off, and we credit the accounts receivable. So the bad debt written off account is here. Yeah, so you put it at the right place. So here we had 250. Yeah, we'll debit it because the person who was declared bankrupt will increase the bad debt written off account. So we'll credit this on the accounts receivable. We credit under adjustment, credit with 250. So that's the double entry. On the same additional information number one, let me go back. We are told that while accounts payable was found to be overstated by shillings 150,000. So this is an overstatement. Yeah, so this is an overcast of 150,000. So the overcast, yeah, so accounts payable, it's always on the credit side. Yeah, so to reduce it, yeah, when it's overcast, it means that it is stated above the actual amount. So to reduce the amount, we'll have to debit. Yeah, we'll debit with 150, yeah, because it was overcasted, it was overstated by 150. And this will affect the purchases account. Yeah, so you credit, as you debit that, you will credit the purchases account. Yeah, because the overstatement affects the purchases, because this was accounts payable. These are our creditors. Yeah, so their purchases account, you will have to credit and adjustment with the same amount, which is 150. Then, yeah, you can see now that it's balancing, 400, 400. Yeah, it makes your work easier. So we go to additional information number two. They're saying the allowance for doubtful debts is to be adjusted to 3% of the accounts receivable as of 31st December 2023. So this is what you do. So we'll calculate the allowances for doubtful debts. So the allowance will be, it was adjusted to 3%. So it will be, we take the accounts receivable provided by the accountant, then you subtract the bad debt written off, which was realized at additional information, the 250,000. So we'll subtract 250 because I'm using the values in thousands. Then you multiply this by the 3%. Yeah, to get the actual allowance. So the allowance was 822. So you come to the account for allowance for bad debts, for doubtful debts. So you just come under adjustment. Yeah, so you will debit this by 822. So let me just write it 822. Then you credit the accounts receivable because it reduces the accounts receivable account. Yeah, so you'll credit this by 822. So just allow me to add them outside here. I don't want to do the additions there. It will adjust even as I continue. So I'll just take 250 plus 822. It's 1072. So I'll have 1072 here. Yeah, now I've just taken the 250 which was there and I added 822 so that I have 1072. And that I'm done with that adjustment. Then we continue to additional information number 3. As of 31st December 2023, there were prepayments of shillings 50,000 and 75,000 towards administrative and advertisement expenses, respectively. So there was prepayment. So we open a prepayment account, and prepayment is an asset. Yeah, it is a current asset, prepayment. So we'll debit it with 70 plus 50. So 70 plus 50 will give us 125. And that adjustment. Yes, we'll have 125. And on the debit side, then there were prepayment on administrative, which one was 50. You see? Yeah, the first one was 50 followed by 75. Yeah, so we'll credit. Yeah, the opposite is true, is that you credit to reduce because it was a prepayment. So we'll credit this other side with 50. Administrative and advertisement, we are told, was 75. So that when you add 50 plus 75 is what we have put under prepayment, which is 125. Continue. Then you go with this. Additional information number. Yeah, then they're saying for the same period, there was an accrued amount of shillings 120,000 towards audit fee. So we open the accruals account. So accruals, it was 120,000. So accrual is a liability. So under adjustment, we'll credit it with 120. Then we debit the audit fees account. Yeah, so we adjust under audit with 120 because it was an accrual. Yeah, so it will increase the audit fee. So the double entry. Yeah, that's how you do it. Yeah, it's sweet. When you do it that way, it's sweet. Yeah, then additional information number 4, the company paid the due interest on the long-term debt on 7th January 2024. So this year was ending on 31st December. Yeah, it was ending on 31st December according to the information we're given, but it was paid in 7 years. So this is an accrual. Yeah, so we'll have 2 accounts. So we'll debit the interest account. Yeah, the interest paid as a payment. So you say interest, you debit, then you credit the accruals account. Yeah, so I'll just come here and say interest. Yeah, you say interest on long-term loan. Is it long-term or? Yeah, long-term loan. You can say interest on 9%, to be specific. Yeah, 9% long-term loan. Long-term loan. Yeah, so this is an interest. Yeah, so that's an expense. So we'll have to debit it. And it was 9%. So you just take, say, equals to 9%. You multiply by the amount. Yeah, the interest amount. 9% long-term debt. So the interest amount was 4,500. So you'll get 4,500. And this 4,500, you'll credit it on the accrual. So I'll add it to the 120, which is already in the accrual. So I don't want to do it there. So let me add separately so that I can change the value. So you'll have 120 plus 4,500. Sorry. It's 4,500 plus 120. What have I added? 405 plus 120. It will give me 525. So on the accrual side, I'll have a total now of 525. Yeah. So I'll change this to 525. Reason being, I'm adding this 45 this other side. Okay, so we are done with that double entry. So we go to additional information number 5. We are told that depreciation is provided as follows: building 5% per annum on cost. So we'll look at the depreciation for the year for building. It was 5% on cost. So that means that it's on a straight line basis. So we'll take 5%, then I'll multiply the cost of the building. Building at cost was 64,940. Then let me also do for machinery. We are told that for every machinery, it was 10% per annum on reducing balance. So I'll just say equals to reducing balance. We'll take the cost. Where's the cost for every machinery? It was 10,300. We'll subtract the accumulated depreciation because it was on a reducing balance. Then is when I'll multiply by 10%. Yeah, to get the depreciation for the year. So my depreciation for the year will be 820. And this other one was 3240. So when it comes to double entry, say here, depreciation. Let me just say building. Depreciation for building, it's an expense, yeah? So under adjustment, we'll have it here. It's on the debit side. Where is it? It was 3247. Yeah, then I'll credit the accumulated depreciation account for building. I'll credit with the same amount, which is 32,470. Then I'll do the same for depreciation of heavy machinery. It's called heavy machinery. Yeah, so I'll debit with the same amount I've calculated here. It was around 820, 820. But I'll credit the accumulated depreciation account of the heavy machinery. So I'll credit it. What is it? What have I done? Yeah, this was not supposed to be here. This was a mistake. Let me delete it. Yeah, so it's supposed to be here. Sorry for that. 3247. Then I'll do the same. Let me just drag to get the 820 there. Yeah. Yes, that's okay. It's okay. Yeah, I put it on the other side of the adjusted. And you have to be very keen. Huh? You might end up messing. So we continue. I'm done with additional information number 5. I'm going to 6. The company annual general meeting resolved that preference dividend be paid. Yeah, a dividend of 11% on ordinary shares be paid. Yeah, so here we'll have two accounts for one for the actual dividend which is paid as an expense. Then we'll have the proposed dividend as a liability. Yeah, so I'll start with the preference dividend paid account. Preference dividend paid. Yeah, so that's an expense. So preference dividend, we look at the how much was it being paid. So you'll go to that. Yeah, we have it's a 10% preference dividend. So just say equals to. Then you take 10%. Multiply by the amount, because yeah, that was actually what was paid. So it's an expense. So the actual amount, as per the information given, what is the actual? It was 5,800. Yeah, so we'll pay 580 for preference dividend. But we have the credit side, the double entry will be the proposed preference dividends, which is a current liability. Yeah, proposed preference dividend. Yeah, because it's not paid at that point in time. So it's a current liability on our side. Yeah, so you credit this with 580. Then the next, that's how you do that double entry, the proposal. Then there was also a proposal to pay a dividend of 11% on ordinary shares. So we'll also do the same for ordinary shares. So we'll say ordinary dividend paid. Yeah, so when it is paid, it's an expense. It is an expense. So we were told it was done at 11%. So we'll take just 11%, we multiply by the total value for the ordinary share. The ordinary share capital was 12,000. So we'll get 1320. Yeah, so we'll open another account for the proposed ordinary dividend. Yeah, as a current liability. It was a proposal. This was not paid. Proposed ordinary dividend. So you credit with the same amount because it's a double entry. Yeah, yes, we pay, but it was a proposal. Yeah, yeah, and you're done with that as a double entry. Then shillings 3 million be transferred to general reserves. Yeah, so when the million transfer to general reserve, we also have a double entry. So the first one, it will be transferred from profit or loss appropriation account. Yeah, so let me just add another line here. Insert another row, sorry, not line, but a row. So and insert that row to increase that. So I'll have the first account I've said is a profit or loss appropriation account. Yeah. Yeah, so that account will debit it with the amount which is being transferred to the general reserve. Yeah, so we debit it. It was 3,000. They've said it was how much? 3 million. Yeah, so it's 3,000 because the shillings are in thousands. Huh? Yeah, so 3,000. But I'll credit the general reserve account, which is an equity. Yeah, you credit the general reserve account, which is an equity. So you credit with the same amount. Yeah. Yeah, you credit with the same amount. I don't know why it's not balancing now. Or because I added that, so I'll have to sum it again and see. I created another row. So let me sum it up to there. So let me grab this. Yeah, so it's balancing at 10, 0. Sorry, I lost my Zoom. Let us continue from where we are. Yeah, so we go to additional information. Number 7, the company maintains a gross profit margin of 25%. So this will be a gross profit margin on net sales, because here we have the sales return. Yeah, so then 8, having been aware of significant, that's an additional information on materiality. Yeah, so I think it has balanced. The adjustment has balanced. There's no any other adjustment to do. So we'll continue. So let me just do this so that it can also balance. So having the adjustment, so we can now be able to analyze the adjusted trial balance. So it's easy. You start with accounts payable. It's on the credit side. So just come here, the credit side. Then you check. It was 4,500, but there was an adjustment of 150. So we are subtracting because it's on the debit side. Yeah, it reduces. It means that it reduces the accounts payable. Then for account receivable, debit side, you pick the initial amount, the original, then you subtract because this is appearing on the debit, this is on the credit. So it means that it's reducing this. So you just subtract that to get that value. Then cash in hand, there was no adjustment. Inventory, there was no adjustment at all. Return outwards, no adjustment. So just take it to the credit side where it is. Then return outwards, then return inwards, you just debit it. Ordinary share capital, credit. Then preference shares, you also credit. Long-term debt, you just credit, there was no adjustment. Sales, you credit, there was no adjustment. Then purchases is on the debit side, so you come and pick this. And the adjustment was on the credit, so you subtract that to reduce purchases. Then bank overdraft, just take it where it belongs, the credit side. Discount received, the credit side. Then discount allowed, you debit, there was no adjustment to that. Building at cost, debit. Heavy machinery, you debit. Then accumulated depreciation, there was an adjustment. Yeah, this and for the year. So you add the two to get the actual accumulated depreciation. Yeah, so you do the same. Let me see if I can just drag from here. Yeah, so this already will add for heavy machinery. Yeah, that's okay. Okay, then audit fees, it's on the debit side. Yeah, so you take this, you add, because even the adjustment is appearing on the debit side. Yeah, so you don't subtract. 11,382. Administrative expenses. There was a prepayment, yeah, so it will reduce because this is on the debit. Sorry for that. It's supposed to be on the debit side. So you pick that, you subtract 50, yeah, because that was a prepayment. And you just drag just drag it down there to give you, it will reduce this for advertisement. Then bad debt written off is an expense, the debit side. So we pick this. Then this is also on the debit. Let me see here. The adjustments on the debit. So just sum them two. Get 400. Then allowance for doubtful debts. Yeah, we had balance brought down of 300, but it has increased to 822. Yeah, so the provision is increased to 822. So here you always take the increase in doubtful debts. Yeah, increase in provision for doubtful debts. So you'll debit it. The difference. Yeah, here now you don't debit 800. Yeah, now you take the 820, the increase, because we are told that it was increased to 3%. So the increase is 822 minus 300. So the increase, you debit the 522. You debit it here because it's an increase in allowance for doubtful debt. If it was a decrease, then you credit it here. So if there was a decrease, if it moved from 300 maybe to 250, yeah, then the difference will credit. Yeah, the difference will credit. But because it was an increase, we debit it. The return profit, that's an equity. We'll just pick it the way it is. Then prepayment was 125. Accruals was 525. Then interest paid was how much? Interest paid is 45. Then depreciation for building. So I can just drag. Let me just drag all the way to preference dividend paid. Yes, I'll drag all the way to the preference dividend paid. Yeah, up to there. Yeah. Then yeah, I'll have this 580. Then I'll have this as 1320. Yeah, now you just copy. Yeah, there's no more adjustments. We'll have this 1320. Then we'll have 3000. Yeah. Then we'll have this also on the credit side. Yeah, so it's balancing at 205, 514, 205, 514. Yeah, so we have balanced it correctly. And you just highlight that, then you bold. Then let me create the top border. Then I'll also create the bottom border. Bottom double border, for that. Yeah, so that's how you are supposed to do that question. That's how you are supposed to handle that question. And you'll get yourself a total of 20 marks. And this question, we are able to predict that audit will come, and it actually came. So join us for the September intake so that we can prepare you well for the December sitting. Yeah, at Jomonde Limited, we'll be able to prepare you well by testing you even on a mock so that you be prepared well before you sit for your CASNEB exam. Thank you so much. Thank you for watching. Please continue subscribing to my channel. Let us get to 1,000 subscribers. Thank you and have a blessed evening.